As we continue our journey for the best overall dividend ETF, today's video brings us to the VYM and looking at the long-term value opportunity that this ETF could bring from Vanguard. Now, looking at this one, it is the Vanguard High Dividend Yield ETF, offering passive income for investors, which we absolutely love in dividend growth. 2.7% yield quarterly dividends, so not paying on a weekly basis, not on a monthly basis, but this is a quarterly basis, and it has a very consistent long-term NAV growth since its inception in 2006. So we've seen almost 20 years of what the VYM can do. Now, looking at this ETF, it is well diversified, primarily investing in large cap companies, which again, some of these larger ETFs, that's exactly what we see. Dividend growth stocks is the primary focus, with Broadcom as its absolute number one holding. Now, the ETF produced 8.6% annual returns. Now, when we start thinking about bigger picture S&P 500, which has yielded about a 10% average return, so a little bit under, but still very strong returns in those years where the S&P 500 does pull back. And when you look at really poised for economic growth in 2025, experts are saying this could really be the year for this ETF. Now, of course, buying the VYM on a dip will really make a big difference on how much you can buy and how much you can acquire of this ETF. So let's go ahead and break it down, and let's hop over to Vanguard's website. Now, this, of course, VYM, the Vanguard High Dividend Yield. I like breaking it down so I know exactly what I'm investing in. Now, personally, I do hold the VYM. This is actually held in my kids' custodial portfolio through M1 Finance. So if you definitely want to use M1 Finance, we got some links below, as well as Robinhood. And of course, if you're not subscribed to the channel, definitely subscribe. We have a ton more investing videos that are going to be coming down the road. But like I said, with VYM, this is something I'm invested in. Very low expense ratio. Now, this I really do like, a 0.06 expense ratio. And if you're familiar with Vanguard, there's actually been a push or talk as of lately. A lot of the Vanguard fees are going to be going lower in the future for these ETFs. So I don't know exactly which ones are going to be affected, but we could see some changes to the actual expense ratio for these Vanguard funds. Now, 30-day SEC yield 2.59, so it falls into a B rating. So not as high as we normally see, but again, we might not want the volatility. We're looking for a lot more stability, which is exactly what this ETF does bring. So looking at the overview, you can see management style, it is an index. So this does track a very specific index, which we're going to look at a little bit. And we're coming up on its 20-year anniversary. And it tracks right here, the FTSE High Dividend Yield Index. That's exactly what it tracks. And it tracks it stock for stock. It is perfectly tracked. Again, similar to what we see with those S&P 500 funds, they do track it very well. Year-to-date return 4.87. So again, thinking of the market pulling back a little bit in 2025, this is still offering a very good yield. And this is where you'll see a lot of stability play in. If the market starts or continues to pull back in 25, you will see these still perform pretty well because they are in domestic stocks. They are in higher yield dividend, looking for value overall. So looking at the rating, risk reward at a 4, so a little bit on the higher side, but you'll notice market price 133.81, again, lower expense ratio. And when we start breaking down what this looks like over the last couple of years, so looking at last year, looking at 21%. Now, this is very interesting because when you look at the growth of this in a comparison to like an SCHD, we didn't see very much growth at all with that SCHD because, of course, a dividend yield like this does carry some of those higher stock or higher larger companies than what we do see. And you'll also notice benchmark just about perfectly on par. 3 years, 9.15, 5 years at 11, and then, of course, 10.5% on the 10-year. So thinking over the last decade, roughly sitting where about the S&P 500, I believe about 1% less. Since inception, a little bit lower because, of course, they incepted this. It was created in 2006, 2007, 2008, of course, was the housing market crunch. And of course, the drop right there. So as we get into this, again, expense ratio incredibly well. It is following the square dividends and beta. Remember, if we're looking at 1, it is tracking the index. It's tracking in its entirety. When you start seeing negative going below that beta, it has actually a little less volatility. If it's going higher, then you have a little bit more volatility in there. So thinking of this one, closing price, like I said, 133, SEC yield, the 30-day SEC yield 2.59. And then we look at the historical price. So when you look again at 2015, I think this is February of 2015, all the way up. So 10 years later, it has went up incredible. It's grown quite a bit. I mean, from $70 right there to 132. So not only would you be getting the dividends, but we've also seen a significant amount of growth out of this ETF itself. And then when we start breaking it up, like we said, it is tied to the benchmark. 533 stocks held in both of these. And you can see it is a perfect parity for what we're seeing in a large cap value blend investment style, which of course is right here where it falls. But then we look at what it holds. This is very important to me because when you start looking at something like a dividend yield ETF, this is part of a portfolio. A lot of people ask why we cover these, why we really look at these, because they make up an entire portfolio. I would not recommend, and I do not recommend when you start looking at dividend growth, that this is 100% of your portfolio. I cannot stress that enough. Me personally, I have a 4 ETF portfolio. This is held roughly in about 30% of the portfolio itself, which means the other 70% is really invested into something that is a lot more risky, a lot more tech, like the QQQM or the VGT, which of course is the Vanguard Growth Fund. But then I also have the core, which is my S&P 500. You could do the Spider, you could do the VOO. There's a multitude of funds you could do, but obviously you want to not hold this 100% in its entirety. If you do, the chances are you're going to miss out on some gains. Now, when we start breaking this down, you can see exactly what the benchmark is. Still heavily in finances. You can see 22.6% in finances. This is very traditional when it comes to dividend ETFs. They are invested in your larger institutions like JP Morgan Chase that have a very strong track record of paying dividends and paying a high dividend yields, growing those dividends, and they have a lot of financial stability, followed by the industrial. Again, when you think of the staple of what they build in, the industrial space, it is something that is a very core, just like the consumer staples and the discretionary spending, which they both hold in here, roughly 10%. It makes a big difference because those are items that are always going to be around. Now, the big thing to note, and what I always look at, technology and telecommunications make up about 15% of this. So not overly invested into the tech companies. We know a lot of tech companies do not pay and have not paid a very high dividend if they pay anything at all. But knowing that we're not heavily vested into technology within the dividend ETF makes a difference because, like I said, when you look at the rest of the portfolio, when you look out to your 10,000 feet view, you will see that this only makes up a small portion of the portfolio. And like we said, specifically looking at like a Broadcom, it is actually 6% of the fund, JP Morgan Chase 3.84. Then when you look at the staples, Procter & Gamble, Walmart, Home Depot, Johnson & Johnson, Bank of America, those are all very big staple companies within the United States, really making a big difference. So what would it look like for our dividend yield if we were to put $100,000 in here? And of course, for this, we want to keep it consistent when we think of the investing aspect and when we start looking at the dividend reinvestment calculator. We want to make sure that we're putting all of these ETFs kind of in a row, keeping the amount. So this is investing $100,000 in here. You can see our share price at 133.81. Dividend amount 96 cents right there, paid out, of course, on a quarterly basis. Growth rate, and look at the dividend growth rate and the share price growth. These are both very, very big because, of course, the dividends, as they continue to grow through time and the share continues to increase in value, it is pretty cool. Now, we are not investing anything else in here. So let me calculate this and show you kind of how it breaks down. So looking at our ending value, you can see right here, we have 102,000. So we got about $3,000 on the first year having that $100,000 in there. So overall, a pretty good return when you think about just making $3,000 for literally doing nothing. This is where you will see the compounding power of money, because if we're parking 100,000 in here, then you fast forward 10 years later and you're at dividends of 43K. When you think about having the ability with investing money to replace your salary or your job, your 9 to 5 in its entirety right here based on $100,000 invested over a 10-year period, that puts us at 237K in this portfolio. $43,000 in dividends, which is kind of crazy. And that's what our end goal is. When you start looking again, total dividends of the 43,000 annually, you're getting 6 grand. So when you think about this, breaking it into a bunch of different portfolios, $6,000 a year, again, is not going to be to the point of replacing your income. But when you start looking at multitude of portfolios and you start, again, looking at the growth factor, because my thought and my logic behind it is when we're getting to the point, this is going to be something that is going to supplement income when you get into essentially your retirement years. So let's say, for instance, I retire in another, right now they're saying 22 years, 23 years before I can actually retire. So if I have $100,000 in my portfolio and I have 23 years to build out this portfolio. So again, thinking of where we could take this to in a course of 23 years, I don't even know if it's going to build it out that long. But when we start looking at something like this and looking at kind of building this out and going to 23 years, you start getting to the point of dividends and you go down again in multitude of years. You're looking annual dividend rate here 23 years later. So if I got ready to retirement, I would have around $17,000 at retirement to have on an annual basis. Now, of course, that includes zero putting extra investment. So sitting just on that $100,000 for the course of 23 years. And again, this is the power of those compounding interest. And I don't think it does the reinvestment. I'm not sure where it is showing the actual reinvestment if we are reinvesting these dividends, which is weird because I see it is crossed out right here. That's a good question. But if we are taking out the dividends on a regular basis, extra investment, length of investment. So again, I don't think this calculator specifically shows us what it's going to look like with the reinvestment. But overall, if we were putting it into the dividend reinvestment, that would make a really big difference on how many shares we're having. And even here, guys, 769 going up to almost 1335 when you start getting 23 years down the pipeline. So it's kind of crazy to think exactly how long and how much you can put in here. But that is the reason why I said part of the portfolio goes into that high yield dividend growth. When we start looking at the dividend growth, I am actually starting to systematically move where I have roughly 70% of my portfolio into the higher risk. We have it into technology. We have it into that S&P 500 funds and moving it slowly into dividends. And of course, as we're getting dividends within the portfolio itself, everything is being reinvested. So it is just snowballing. So having something like this that is going to provide me an annual dividend yield, even at the beginning of this, is I'm reinvesting $3,000 on an annual basis, not including my own contributions, not including anything else. That is going right back into my portfolio. Then, of course, I get dividends from that QQQM and from that VOO. Again, that go right into this to build up the portfolio on top of the contributions that I'm making on a regular basis. But all right, guys, so that is going to do it for today's video. Definitely wanted to cover the VYM. This is another one, like I said earlier, I do hold in my kids' portfolio, and I think I hold it in their portfolio around 20 to 25%. Because, of course, them being younger, we want to take a lot of risk right now because we have a lot of time and a lot of runway when we get ready for those retirement accounts. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.